Hello and welcome to Portfolio Matters Weekly Update, week 76. And we are joined this week by Stuart Owen from Tokyo. But before we get into it, Stuart will read the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Stuart. Okay, this week's news. Well, Russia has been cutting off the gas supplies to Europe, and we will show you some charts on that this week. But in response, Germany has started reopening its coal power stations. And this is the height of environmental stupidity, having closed all their nuclear power stations. They're now burning a lot more coal, very bad for the environment. Ukraine managed to hit a Russian oil refinery 150 kilometers inside Russian territory with a suicide drone. So expect more disruption in the oil market. In China, we've had yet another property developer default on its US dollar offshore bonds. In the UK, we had inflation numbers, and inflation rose a touch to 9.1%. Reminder, the Bank of England's target is 2%. And finally, there were riots in Nepal over fuel price rises, and we are expecting lots of disruption in emerging markets as fuel and food prices rise. And we've had defaults in Sri Lanka and now food riots in Nepal. So watch this space. So some charts related to the news. Well, these are the Fosun dollar bonds, and we're getting progressively more defaults in Chinese offshore bonds, not the onshore ones as yet, but offshore. International investors are losing their money.
Heath, just adding to that, I think there was a story during the week about some distressed debt investors beginning to sniff around the situation in China. And if you want to use that sort of news story as a marker of when you might want to begin thinking about opportunities, I think it's quite interesting. I mean, I'm not talking in particular about Chinese developer offshore bonds, but as a marker for when a cycle is turning. I thought that was quite an interesting news story.
Yeah, and I saw that as well, but I was deeply skeptical. And the problem with China is I just don't think your contracts are enforceable unless you have the backing of the Chinese Communist Party. So unless you've got political connections, I would avoid. Now, this is the spread between Italian and German bonds, and the ECB has managed to talk them back down over the course of the week without actually doing anything. Let's see what their anti-fragmentation plan is. Okay, on to this week's economic data, and we had some flash PMIs for June. Actually, I thought most of the data this week was important, so we're going to go through most of it, I'm afraid. So US existing home sales actually beat expectations despite very high mortgage rates. So the US housing market is showing surprising resilience. We have a big special section on US housing coming up. The flash PMIs for June in the US were very disappointing. So manufacturing missed expectations by quite a margin. In May, it was 57. It was expected to slow slightly to 56, came in at 52.4. A big miss. Services also missed, as did the composite. In the UK, we had CPI numbers, and they were actually slightly weaker than expected. still up on April. So the May number came in at 9.1%, up 0.1% on April, and below expectations. So inflation is still rising, but the rate of increase has slowed. Reminder, the Bank of England is expecting it to peak above 11% in October. So this slowdown in growth may just be temporary. I should also point out that RPI rose significantly, up 0.6% on the month to 11.7%. We also had interesting producer price inflation numbers in the UK. So input inflation was up 22% year on year, output up 15.7%. So UK businesses are being squeezed, and you expect to see their margins squeezed. In the UK, we had PMIs, and they were actually surprisingly resilient. So the manufacturing PMI was expected at 54.2. It came in at 53.4, so only a slight miss. Services and the composite both beat expectations by a small margin, although they're just above 50. So they're saying that the economy is expanding, but only slowly. In the Eurozone, we had big misses. So the manufacturing PMI was expected at 54. It came in at 52. We had misses in services and the composite, both of which are barely above 50. So the picture we're seeing is of global growth that is slowing but remains positive. Stuart, some charts.
Okay, so first up, the UK CPI year on year, which we can see at pretty much 9%. This, of course, is the new measure, not the old RPI. The core CPI, excluding food and energy, pretty much at 6%. And RPI, the old-fashioned one, which I think is still used for a few more years in the index-linked market, as Keith pointed out, almost 12% now year on year.
Yeah, UK retail sales fell 0.5% month on month in May. So the brief uptick in April didn't last. And if you look at the entirety of this chart, you'll see that retail sales have been slowing across the year, and expect this to get worse.
So this is the UK manufacturing PMI. So as Keith pointed out, above 50, so expanding, but it's come off the very strong highs that it had in the post-COVID bounce. So expanding, but not too strongly. And the UK services PMI, pretty much the same sort of picture. UK composite, therefore, showing exactly the same story, modest expansion. The European manufacturing PMI, a rather more volatile pattern than the UK, and coming down towards 50, but still above 50.
Yeah, but coming down fast, frankly.
And European services PMI, also coming off not quite as aggressively as the manufacturing, still above 50, but not looking too healthy. And therefore the composite, being the average of those previous two, is just above 50. US industrial production year on year, not too bad at all. What's that, about 6 or 7%, and not seemingly showing much evidence of slowing down. US existing home sales, well, here I think we can see the effect of rising mortgage rates, with existing home sales coming off from around, is that 6 million to just under 5.5 million. US manufacturing PMI showing a pattern, I guess, rather similar to the European PMI, coming off pretty sharply, but still above 50, so still supposedly expanding. US initial jobless claims, well, this seems to have bottomed. There's a bit of a sort of a U-shaped pattern here if you look at it over the long term. So initial jobless claims now about 230,000 per month. Right, so continuing jobless claims, though, not too bad at all. That seems to have flattened out, but not been picking up yet, which I think we see in the unemployment numbers and other stats about a generally healthy labour market. US mortgage applications, well, there's a lot more to say on this later, but actually some reasonably positive numbers on this particular measure.
Yeah, surprising resilience in the US housing market.
And this is the reason that we're slightly surprised, because this is the 30-year mortgage rate, which has now touched 6%. I guess there could be some lagging effects here where previously signed contracts are just coming through into the completion statistics. And of course, this is the mortgage rate for new applications. So in summary, the US and European PMIs are deteriorating, though they remain above 50. So growth is positive, but it's slowing. US home sales are slowing down, but mortgage applications are still rising. UK PMIs are barely positive, but have stopped deteriorating. So growth is slowing. There's the sort of stall speed risk, but we can't actually say that there's concrete signs of recession yet.
Thanks, Stuart. Okay, on to one chart for this week. And this is a chart showing electric vehicle penetration in Norway, where they have the highest level of electric vehicle adoption in the world. And almost 90% of new car sales are now electric vehicles. But the blue bars at the back are Norwegian fuel demand. So light blue is diesel deliveries, dark blue is gasoline deliveries, and you'll see that they have barely changed. So there's a lot of cars still on the road which are internal combustion engine, and 100% of the truck fleet is still diesel, and there's very little prospect of that changing in the near future. So
that's fascinating, isn't it? That's
yeah.
I do wonder whether there's a sort of second car effect. Perhaps you have an electric car for pottering around town, and for anything longer, you want the internal combustion engine.
That's a very good point, actually, Stuart, because in our own household, we would certainly consider getting a electric vehicle for around town, but for long distances, no way. So in summary, the energy transition is going to be slow, and oil will see continued strong demand for many years. Cars are only around 25% of oil consumption. So even if you were to substitute electric vehicles for all the cars on the road, which would take a very long time, you would still be left with strong demand from the other 75%, and petrochemical demand for oil continues to grow.
Yeah, Keith, and I think we've mentioned before quite often about emerging markets, and of course they're not particularly going to be buying EVs, and so as you buy your first petrol car, that's now in the stock and is going to be there for sort of 10 years or whatever. So there's a stock and flow issue here where we'll keep adding to the stock.
Yep.
So inflation watch. I don't think no numbers yet, obviously, for June, but May numbers for CPI for the UK now 9.1%, RPI 11.7%, as we were mentioning before. US CPI 8.6%, Europe 8.1%. Still QE going on for the moment there. Obviously, that's about to be wound up, but at the moment, still some money creation. Looking within the EU, Germany 7.9%. I can't imagine what the German tabloid newspapers make of that. It must be a pretty brutal headline. Japan, however, just 2.1%, and I can verify that there's very little inflation here. It's with the yen falling so much, and with very little inflation, it's a great place to take your holidays.
So 3 charts from the Visual Capitalist that I thought were really good, talking about the 3 different types of inflation. And so this chart shows the money supply. And reminder, price times quantity equals money times velocity. And you've seen here on this chart, the purple line is money supply, percentage change on a year ago. And that is up over 25% year on year. Now, all things being equal, if the velocity of money stays the same, you would expect to see inflation of 25%. Bear that in mind. We've got more charts relevant to that coming up. Second type of inflation is consumer price inflation. So how monetary inflation feeds through into the price of goods and services. You'll see that in context, we've seen a big surge in CPI over the past year, the highest rise in inflation since the late 70s, early 1980s. But actually, the chart I really wanted to talk about was this one, asset price inflation. So this is the total value, nominal value of all the financial assets in the world. And you'll see as a percentage of GDP, they have shot up. Now, that is a function of low interest rates. And as interest rates rise, frankly, I'm expecting asset prices to go into reverse. And so household wealth to come down. And I think a lot of this wealth is frankly illusory. And your job as a private investor is to try and protect as much of these gains. Everyone's made gains, but I think a lot of those gains are going to disappear. And so, and regular viewers will know that I put most of my assets into cash over the last month because I think asset prices are heading lower.
Keith, just jumping back to that CPI chart, the thing which has always struck me is an observation I read that when all the QE was just going into the financial system, it just going into bank reserves, that sort of thing, it didn't really cause consumer price inflation, though obviously it did cause asset inflation. But the consumer inflation was kicked off when we got the fiscal largesse, when we got money in people's pockets. That got spent, that pushed up prices. Whereas the initial rounds of QE were more about ensuring financial market liquidity and didn't really lead to much CPI inflation.
I completely agree, Stuart. So one of our viewers this week sent me a whole load of monetarist charts talking about how QE was inherently inflationary. And I agreed up to a point. And I think QE was only really inflationary because of the huge fiscal stimulus done during the pandemic. If it had just been pure monetary, then it would have, all it would have done is buy assets from the bank, which it would essentially just change the asset mix for bank reserves. But because it was essentially buying government issued bonds, it was inflationary. You added to demand. Without the increase in fiscal, there would have been no increase in demand, no increase in inflation. However, having said all that, one of the core assumptions of QE is that it is reversible. And I just don't think it is. I think you can pump all this money into banks and the monetary system. But the moment you try and reverse it, I think you're going to see real interest rates rise and you'll provoke a financial crisis and a recession, and essentially you'll have to stop. So when the Fed thinks that it can take all this money back out of the system, I just don't think it can. So I think inflation will inevitably rise over the next few years.
Yeah, I think you're so right that the QE is so difficult to take back. I just imagine every financial institution pushing every sort of leverage limit to the every leverage restriction to the limit, and then when you take away the liquidity, there's so much fragility there. It's very difficult to reverse course.
Absolutely. We're seeing the levels of indebtedness are incredibly high. The world economy is very sensitive to rises in interest rates, and QT is going to raise interest rates. So raise effective interest rates, I should say.
Right, back to a favorite from last year, that is shipping rates. And this is a chart showing the cost of shipping a 40-foot container from China to the US West Coast, which had gone up from, a few £1,000 dollars, I guess, before the pandemic, went up to $20,000 and has now retraced half of that, just under $10,000 now to move a standard container.
So goods inflation, hopefully, should be coming down. We're now having negative inflation in shipping.
Here's some data looking at the change in net worth between before the pandemic and now, but dividing it by wealth level. So you can see the bottom 50% of people by income or by wealth, I think actually, rather than income, their change in net worth, almost 100% increase, presumably from very low to low. The top 1% doing well as ever. But I guess that this is some evidence of removal of financial pressures on less well-off people.
Yeah, everyone's got savings. I mean, the average here is just absolutely extraordinary. Everyone's got more wealth than they had pre-pandemic by an average of what, 25, 30%?
That is phenomenal, isn't it?
Yeah, that's going to support savings. And going back to the earlier chart of asset price inflation, I mean, I think a lot of this is caused by interest rates hitting zero. And as interest rates rise, the discount price for future cash flows rises, their value collapses. So I think a lot of this is going to disappear.
Here's an analysis breaking down the UK inflation rate of 9.1% into its different contributors. And basically, there's a big skew towards transport and housing and household services contributing to the rise in CPI. German PPI, I think this is a chart that Richard would love or hate, depending on how you look at it, but it's just incredible, isn't it? 33.6% year-over-year increases in German PPI. Now, I think in the UK, manufacturing is only about 10% of the economy. I'm assuming it's more in Germany, but even if this inflation was only capped to that part of the economy, that this is just such high numbers that you wonder how any business can manage itself.
Yeah, absolutely.
And a reminder that for the moment, at least, the ECB is still printing. The balance sheet continues to expand, and presumably there's lots of boffins working away on how they can use the balance sheet, the assets they have, and the maturity of those bonds to support the anti-fragmentation tool, which hopefully they will come out with at some point.
Yeah, I thought the absolute numbers were really interesting as well. So the ECB balance sheet now equals 82.4% of the Eurozone's GDP, compared to 36.6% for the Fed, 39.6% in the UK, and 136.3% in Japan. I mean, the EU has done vast amounts of QE, actually.
Quite. I mean, if you imagine that, if you'd known that 10 years ago, you just would not have believed it.
Yeah,
it was supposed to be the guardians of monetary rectitude, but look at it, it's phenomenal. But talking of the BOJ and that 140% balance sheet of the BOJ, here is one of the reason that it's got to that level, which is the BOJ bond purchases trying to defend the yield cap. I think it's about 0.25% on the 10-year bond they're trying to defend. And I'm not a hedge fund manager, but you've got to think that's a great asymmetric bet. You bet that they're going to burst that ceiling. The worst that can happen is, okay, that the bond comes off to 0.2% rather than 0.25%, and you don't lose too much. But if you're short the 10-year Japanese government bond and that cap collapses, well, you're going to make a lot, and it's a very asymmetric bet.
Yep, good point.
Deutsche Bank have been analysing euro area inflation. Again, I can hear Richard speaking in my ear. He doesn't believe the modelling because it all comes back to 2% in a couple of years' time. Everything mean reverts, and there's no real problem. But for what it's worth, You can see in particular the green bars here making their contribution to overall CPI inflation. That's energy, going from very big positive contributors to some negative contributors in, what's that, about 18 months' time, as energy prices, presumably in Deutsche's model, come back and presumably fall a bit.
Yeah, I mean, I agree with their analysis that energy prices will come back down as the euro area, in fact, the world goes into recession. But what I find really interesting about this chart and the way they've broken inflation down is you have massive contributions from food and energy and not so much from the core. And essentially the assumption is that there is no wage price spiral, that workers do not demand higher wages in response to higher inflation. And we know in Germany that the steel workers are demanding wage rises of, was it 7.8%? So, you know, we'll have to see what happens, but this could get out of control.
And here's a chart looking at the outlook for the Fed's policy rate. And we can see in the, hold on, what's that? In the grey bar, the forward rate peaking at the end of this year at just under 4%, and then gently coming off to something like 3% by December 24. Though this chart is from Nomura, who seem to be forecasting a much faster pace of rate cuts after a period of, perhaps sort of 9 months of rates peaking at, as I say, just under 4%, but they're forecasting some pretty big cuts, as presumably they believe these interest rate increases over the next remainder of this year lead to a recession.
My own forecast would be it doesn't get anywhere near this high. I think we start going into recession in Q3, Q4 in the US, and the Fed loses its nerve. But we'll just have to wait and see.
US five-year forward inflation expectations. This is a somewhat complicated calculation, but is a measure, I guess, of medium-term inflation expectations are shown here for different markets. So we've got the US, for instance, coming in at about 2.25%. So implicitly, markets are assuming that there is an ability to get inflation back down, and there's no medium-term problem. But as Keith has pointed out, if you do get into a wage price spiral, then all bets are off, and these numbers are far too low. So in summary, global supply chains do appear to be normalizing, judging from that chart of the shipping rates from China. So goods inflation should begin to ease. Secondly, consumers have retained their savings from the pandemic, so they have dry powder that they could either invest or use to buy things. In the UK, CPI inflation growth has slowed, but it's far, far too early to say whether it has peaked. Again, as Keith pointed out, wage price spiral is the risk, and there are many ongoing wage negotiations in the UK at the moment. The Bank of England is forecasting inflation to keep rising for the moment into H2. What was their peak forecast, Keith?
Over 11% now.
Phenomenal. And that's on their CPI measure, not RPI.
Okay, a quick section on last week in equities. And last week was bad. So this is the S&P 500, and you'll see we had a really sharp sell-off. The same in the NASDAQ, bounced back over the last couple of days. And this is the XLE ETF, which is the US energy sector ETF, and it has absolutely collapsed in a pretty much a straight line over the course of the last 2 weeks. Well, what's going on?
Okay, well, I just want to put in there that chart is particularly painful to me. I patted myself on the back when I followed your portfolio positioning at around the turn of the year. I bought the UK listed version of exactly this fund. I've been patting myself on the back all the way up. I can't believe just how brutally it has fallen over the past couple of weeks.
Well, it's interesting you say that, Stuart, because frankly, as somebody who's traded the energy sector in various cycles over the years, this is exactly what happened to me in 2018. So I actually did a my worst trade on this, and if viewers are interested, they can dig that out on the Portfolio Matters website on YouTube. But essentially, I was knew in 2018 that my oil trade was coming to an end. I'd done very well, and I thought I would hold on till year end, which was like 2 or 3 months away. And then over the course of half term, the share where I couldn't trade, the shares absolutely collapsed and essentially all my profits disappeared. And one of the lessons I took from that was when you're having a very strong bull run, you need to get out. As I've said before, the old stock market saw about the market eats like a bird and shits like a goose is absolutely true. You know, it grinds its way up, and then when it sells off fast. And you either have to be incredibly nimble, or you just have to average your way out on the way up when you think it's reached fair value. And actually, previously at Weeklies, we have talked about how inflows into energy ETFs were astonishingly strong. And I said that looked like it was becoming a crowded trade. And the trouble with crowded trades is you have lots of weak holders. The moment it starts to sell off, they rush for the exit. And frankly, I think that's what's happened. But so what happened last week? Well, previously we talked about this chart, which is events around option expiry dates in the US. Now, last Friday was an option expiry date. And actually, after we recorded the weekly, there was a bad sell-off in the US. And you'll see option expiry dates tend to mark turning points in the market. Now, I think we've had the sell-off was so strong that we're due a little bit of a bounce now within an ongoing bear market. And all the sentiment indicators are just astonishingly bad. The Bank of America bull bear indicator has hit 0. Now, I don't know how it hit 0. And the CNN Fear and Greed Index is in extreme fear. So any increase in sentiment, any piece of good news, frankly, you'd expect to see a little bit of a bounce. So we've had a really bad couple of weeks following the surprisingly strong CPI numbers in the US. And that option expired last Friday seems to have concentrated the selling. But sentiment is now so poor, frankly, that I think any piece of good news could see a decent bear market bounce.
Right. Coming up now is a little segment on the high yield bond spread as a macro indicator. Now, I came across this when listening to a podcast from Bloomberg, the Odd Lots podcast. And just to do a little plug for them, they do some really interesting oddball collections of observations. You've got 2 interviewers spending 50 minutes interviewing someone who knows about a topic properly, really going into details. It's not 2 or 3 minutes of headlines. It's really quite interesting. So this segment is basically taking an idea from Dan Rummerson, and he has been looking at the predictive power of the high yield bond spread. So this, of course, is where you take junk bonds and you look at their yield compared to equivalent maturity or equivalent duration treasuries. So that's the spread. When the spread is wide, that's a reflection of fear and of credit risk of these junk bond issuers. And conversely, when the spread is low, that indicates a measure of risk tolerance and optimism. And we can see here a fairly short-term picture of the high yield bond spread, which reached 11% during the pandemic fear, and prior to that had been trading at around 4% compared to US Treasuries. That's the short-term picture. If we then look at a longer-term picture, you can begin to get a sense of that there might be a bit of a range in the high yield spread, from about 2.5%, only 2.5% extra yield as your compensation for these junk bonds, up to perhaps around a 10% spread. Though, of course, after having defined a range, there is, of course, one big exception, which is the global financial crisis, where spreads went to over 20%. Now, the spread is quite interesting at the moment because it's beginning to get certainly towards halfway in this range and possibly towards the upper end of the spread range, i.e., junk bonds have been selling off compared to treasury bonds over the past 6 months or so. So that's the background of the range that the high yield spread can have. But Dan Rumsden was making the point that the level and the rate of change of the spread can be very useful as macro indicators of where we are in the economic and market cycle. So this is a very stylized version of what he's talking about. So he's got 4 different phases of the economy. We can think about a recovery phase from a recession where spreads are wide because people are nervous that a poor economic situation will lead to defaults in the junk bond companies, but where the spreads are narrowing. So they're going from very wide to wide and from wide to average, like that. Now that's, for him, if you look at the level and the direction of change of spread, would indicate you're in a recovery situation in the economic cycle, and therefore you would want to be invested in things like small cap value or in oil because the economy is picking up. The next phase of his cycle is to say, well, spreads are continuing to narrow, there's optimism, people don't expect defaults, but now the level of spreads has narrowed and is getting towards that about 2.5% minimum. So this is reflective of the growth of a phase of the economy. And you might want, in his analysis, to be exposed to large cap growth stocks or to the copper market. Then the overheating phase arrives. And now that's where spreads are very narrow and they're beginning to rise. And that's the period we've just been living through. That's overheating. So for him, the investments to prefer then are gold and treasuries. Overheating moves into recession when the direction of change of spreads continues to be up, but where the spread level is now reaching wide, i.e. a sort of distress situation. And I guess if we had to choose at the moment, we're moving from that overheating phase to the recession phase. So for the moment, this wouldn't yet indicate taking a more aggressive stance, but this would suggest still stay defensive, stay cautious, because spreads haven't reached the wide level where the markets are indicating extreme pessimism and distress. Having said that, his recommended asset allocation of gold and 10-year treasuries has not worked, at least so far.
The other thing I'd add, Stuart, is in the overheating phase, he's recommending high yield bonds at precisely the point where this chart is all about how the high yield bond spread is widening at that point, and therefore high yield bonds will be selling off. I think that's quite an odd recommendation.
It is. I wondered even whether that was a typo, because the whole point, I would think, would be to be buying the high yield bonds in that first phase of recovery where the spread is wide and is beginning to narrow. And so I think we should be on the alert for when the spreads reach that 8-9% level, and that's the time to say, look, there's been capitulation, that there's extreme distress, the risk is priced in. But I'm with you. I was very surprised to see that recommendation there. Okay, now this table is somewhat busy, but is looking at the average return of different asset classes in that recovery, growth, overheating, and recession phases. So it's from this table of historic performance during those periods that he derives his asset allocation recommendations. But if you're interested in the detail, pause the video and have a look at this moment. And this is some asset allocation recommendations. So I'm not looking just at the historic asset class performances, but what sort of allocation you might want to look at, again, during those 4 phases: recovery, growth, overheating, and recession. I think these are very difficult to take literally into one's portfolio. It's more an indication of the sort of direction of bet and type of exposure we as private investors would be looking at. But just to take a step back and repeat again, the issue here is the degree of spread, how wide the spreads are, and secondly, whether the spreads are falling or rising. At the moment, we seem to have average spreads, and those average spreads are rising. So we're in overheating, moving to recession, I'd say. So I thought this was quite interesting in itself. Also, I thought it was particularly interesting for portfolio matters because Keith's approach is very much to be looking at making top-down macro calls. And I thought this was a very good way of calibrating where we are in the cycle. So we'll be looking at that monitor of the high yield bond spread regularly in the future.
Okay, and now a deep dive into the US housing market. Now, regular viewers will know that we believe that the housing cycle is a predictor and a cause of the economic cycle, and therefore we go on about the housing cycle quite a lot. Okay, so in the US, we had numbers for May which showed that the median house price continued to rise despite strongly rising mortgage rates, although the number of houses sold are in decline. So this is year-on-year house price inflation, and it continues strong at 14.8% in May. But although house prices are rising, sales volumes are falling. And I should point out that all this data is from Redfin, not from the usual Case-Shiller. And if we break down housing sales by price segment, you'll see that at the lower end, we're having a real collapse in sales volumes. Presumably, this is because the buyers there are highly price sensitive and mortgage rates are rising, and they are struggling to obtain a mortgage. So these are existing home sales year on year, and you'll see slowing. But the housing market remains hot. Houses are selling fast, an average of only 16 days on the market. So we're getting this contradictory market where prices are rising, they're selling quickly, but volumes are falling. And 59% of US homes actually sold above the listing price. But I just don't see how that's sustainable when mortgage rates have hit 6% for the average 30-year fixed. And as a result of that, mortgage applications are falling quickly, down 40% from their peak in 2021. And historically, there's been a strong correlation between house price inflation and mortgage applications. And as the mortgage applications collapse, so you expect to see the house price inflation fall with it.
That's a very interesting correlation, isn't it? I don't know how much we can say about levels rather than direction of change, but if we do try to sort of make an eyeball guess, that this level of mortgage applications would still be consistent with prices sort of remaining flattish rather than falling. It's difficult to know how much you can read across, but certainly the rate of change of house prices has got to fall off pretty rapidly.
Yes, that with current data, Stuart, it would be consistent with more house prices essentially flattening in the future. But frankly, I'm expecting mortgage applications to keep on falling. Thought this was a really interesting chart looking at US house prices, which are the red, blue, and white lines, depending on which region, and CPI. And it's all rebased to the peak of pre-GFC house price bubble. And house prices are now higher in the 20 cities, the core composite of Case-Shiller index, than they were pre-GFC when adjusted for inflation. So house prices are really expensive again. And if we look at London, the same is true. And briefly talking about the UK, well, UK house buyers are losing interest. The black line is new buyer inquiries minus new sales instructions. So we've got net more new sales instructions than new buyers. And once again, there's a correlation, and you'd expect to see house prices come down in the UK in coming months. And going back to the US, the house price to rent ratio is very elevated. All the indicators are that US house prices are very expensive compared to fundamentals. And US home buyers are increasingly pessimistic. 80% of respondents to a survey by Fannie Mae said it was a bad time to buy a house. And leading indicators look really, really bad. So existing US home sales are falling, but remain actually pretty strong currently. And as we talked previously, the last couple of weeks has seen a surprising uptick in mortgage applications and continued house price growth. But the number of active listings is rising as owners rush to sell before the bubble pops. And they've started to cut their asking prices. And this is also important in the US because when you look at wealth and the wealth distribution, you'll see that most people have most of their wealth in their house. And as house prices come off, the wealth effect would tend to mean that they will reduce their expenditure, which is deflationary. And while we're talking about that, refinancings to extract equity from housing in the US are down 92%. So that is the black line, 2022. Essentially, mortgage lenders have stepped back from allowing cash out refinancing. And this is global house prices. And you'll see, actually, we've talked about this before, but Canada and New Zealand are particularly bad.
That is extraordinary, isn't it? So the line that interested me there was Italy. I mean, look at that. Italian house prices have basically no change since the year 2000. So is there some opportunity here, Keith? If the euro breaks up, what do you want to do? Sort of, you want to buy it, but in local currency? Is that the bet?
Well, exactly. When the eurozone completely dissolves, I have my eye on a little Greek property, which I'll be able to buy for £2.50, I reckon. But we'll wait. And this, I thought, was an absolutely amazing chart. This shows the monthly cost of paying the mortgage on the median US house price. And since 2006, it's up about 90%. But since its lows in 2012, it has trebled.
There's so much of that has happened over the past year, hasn't it? I mean, that's the scary thing, that the gradient on in the last year. It's just scary.
Yeah, and that when rates move that quickly, something breaks. With this much debt in the system, I think there's going to be a lot of financial stress out there. But having said all that, and we've been pretty bearish about US housing, this is existing inventories. And actually, there's not much housing for sale in the US. So that should support house prices. In summary, the last couple of months' data have shown the US housing market is surprisingly buoyant and resilient in the face of rapidly rising mortgage rates. But fundamentals are beginning to exert themselves, and we are expecting the US housing market to slowly start rolling over and the US economy to follow it. Now, I did a special podcast on why the housing cycle is the business cycle. And if you're interested in this topic, I urge you to watch it. And while we're on US property, our American viewer, Herman, sent me a really interesting article from Bloomberg. So, US mortgage lenders are now lending not on income, but if you buy a property to rent it out on Airbnb, they will lend you the money on the expected future income from the Airbnb rental rather than your own personal income. And so if you think about Hyman Minsky's credit cycle and how the final phase of the credit cycle is Ponzi, where essentially you start lending money on the expectation of future earnings growth and future asset price rises. This is where we are. Essentially, these loans are only repayable if the economy continues to be strong and people continue to go on holiday. Essentially, if there's a recession and people stop going to expensive Airbnbs, then these mortgages disappear in a puff of smoke because the borrowers don't have any personal income. In fact, most of their personal income comes from Airbnbs. So they're very highly geared. So borrowers typically have to put down a deposit of 30% and hold 6-month mortgage payments in cash in the bank, but they're highly geared. Now, I should also say this is quite a small segment. So in the last quarter, there's only about 5 billion of lending to landlords, but it's been growing quickly. And this article was from Bloomberg, and it looked at Tennessee, and the whole Airbnb sector has been growing quite well, and average daily rates, very strong. But these are quite expensive properties. Frankly, I think they are geared to the economy, and the economy slows, you're going to see real problems. So in summary, dangerous lending is back, and this is all done through mortgage brokers. Once again, there's this agency problem where their mortgage brokers are incentivized to find borrowers and lend the money, expect bankruptcies.
Okay, turning to the weekly checklist, here's the data on equity markets. We can see actually a bit more divergence than I realized. The UK and Europe are basically down little on the week, 0.4 and 0.5% respectively, whereas the S&P 500 up 3.5% and the Nasdaq 5.5%. Well, I guess in choppy markets, when you're measuring a top to a bottom, you can get large apparent movements.
Can I just come in there, Stuart? So I think what's happened this week is that the markets have started to price in a recession. And therefore, you saw a bit of a move down in long bond yields. And that means technology stocks become more attractive. And because the market's pricing in recession, commodity stocks become less attractive. And so the all share has a large weighting in commodity stocks. It had a poor week, whereas America has big weighting in tech. It had a bounce. But in the previous weeks, the US had done much worse than the UK.
Oh, yeah. So there is a logic behind these moves. It's not just random. Yeah, that makes a lot of sense. Yeah. The Bitcoin move, again, surprised me by its modest statistic, down just 1.4%. Given all the chaos that's been happening in the crypto world, I would have guessed that number was much worse. The pound continuing to drift off, now just under 123 to the dollar. The dollar index more broadly pretty flat on the week. Now, looking for, again, cyclical signs, are we at a bottom? Well, if we look at flows into equity and bond funds, the answer is a resounding no. There has no capitulation in the equity market, where cumulative flows have flattened off but not gone into reverse. By contrast, if you look at bond funds, the cumulative flows peaked late summer, autumn last year, and have been coming off pretty consistently since then. So fixed income, some signs of investors backing off, but equities, surprisingly not. Again, trying to look at indicators of when we might reach an equity market bottom. Here are some ratios, PE ratios at prior bear market bottoms, and you can see the numbers are around 12 times earnings is an average of previous bottoms, but there's a big range in that. The 1974, 1982 bottoms were more like 7 times earnings. Given that the current S&P PE ratio is more like 18.5, there's still quite a bit to go just in terms of valuation. And if you think the E part of the PE is itself vulnerable, then there's even more room to fall. Trying to get a little handle on where earnings might be going. This is a very interesting correlation. You got the ISM manufacturing PMI as a leading indicator of the year-on-year growth rate change for the S&P earnings. And again, this is therefore more of a top-down analysis of where earnings are likely to go, and it's not looking very positive. Again, trying to read across the chart, it wouldn't necessarily say earnings falls, but definitely no more high rates of earnings growth. And I think the contrast in particular here is with the bottom-up analyst forecasts, where the data I've seen still looks very optimistic in terms of future earnings growth. And my recollection from when I was a professional fund manager is that the top-down stuff tends to be rather more accurate, whereas the bottom-up tends to be very optimistic and to take the company's projections rather too rosily and take too much on trust. Now, here's a very interesting chart forwarded to us by Matt Jackson. This has got quite a bit of information in it, but is really worth, I think, paying attention to. So it's trying to display two different things. One is the duration of a bear market, and that's the vertical lines here. And it's also trying to look at the average and the least and the worst percentage change drop in a bear market. So it's both duration and level of pain. And both indicators would suggest we ain't there yet. In terms of duration, we haven't reached, it was about half the duration of the average bear market. And we've only just reached the lowest typical drop in price. So in both axes, as it were, how much further we've got to go in terms of time, how much further we've got to go in terms of percentage fall. Well, yeah, we ain't there yet. There's still more pain to come. Such a pity Richard isn't here this week. Here's a very interesting chart, or I don't know quite what to call it. It looks like a football from the World Cup, but it's looking at the ownership pattern of Bitcoin. And there are many statistics in this, but it looks like 4% of crypto accounts own 96% of all Bitcoins. Now, I can't believe that all of these Bitcoins have just been sort of lost on a server which has been dumped in a municipal tip somewhere. There must be real holders here looking to one day cash out massively. But as Keith has said here, Bitcoin was never decentralized in its distribution. It's very, very lopsided in its ownership. Capital is flowing out of crypto. There are so many stories about what's been happening in the crypto market in the past couple of weeks. It really looks like an implosion here. And just to add to this, so many of the stories we read about crypto are all about the price of the coins, the price of the token. There's almost nothing about the actual use cases or the networks that they're supposed to be supporting, the new economy they're supposed to be building. We got to the speculative stage without doing any of the actual useful tech. Right, looking at another dimension of what's happening in the crypto world, this is the market cap of the Tether stablecoin. Now, Tether is supposed to be one-to-one exchangeable into a dollar, but the reserves that they hold for that conversion are subject to some debate, shall we say. So there seems to be some nervousness. This is not the exchange rate of Tether to the US dollar. This is the market cap of Tether, which peaked at, I'm guessing that's in billions, of about 82 billion, and is now more like 66 billion. So there's some strong evidence of people getting cold feet. It looks like people would rather have a dollar than a Tether. So in conclusion, the market still remains expensive on traditional metrics. The bear market is young relative to historic comparisons of how long a bear market typically takes to play out. And investor positioning remains very high compared to sentiment.
Yeah, so investors still have huge long positions in equities, despite feeling quite bad about the economy and actually equities. If that changes and they decide actually to sell down, then this bear market gets a lot worse very quickly. Okay, thank you, Stuart. On to commodities. So last week was a terrible week for commodity prices as Jerome Powell started talking about the possibility of a recession. And does that presage the beginning of a bear market in commodities? If we look at the returns of commodities during 2008, really, really terrible. So it had a big run up over the past year. Then as the recession hits, prices completely collapse. So something to be wary of. Okay, on to energy commodities. So bad week. Brent was down a further 8%, WTI down further 11%. In Europe, natural gas prices continued to rise as Russia has reduced gas flows and there are fears for the coming winter. In the US, natural gas prices fell a further 16%. Now, remember that one of the big LNG liquefaction plants has had an explosion and is offline. So that is reducing US natural gas demand. Coal was flat, uranium drifted off a bit. We don't have any EIA inventory data this week because the government there is having problems and hasn't published any. But the Baker Hughes rig count ticked up by 4. Energy commodities had a bad week. This is a log scale, and the oil price has closed below its moving average. Is that a bad technical sign? And energy stocks had a really bad week. This is Brent. Now, I thought this was an interesting chart. Chinese oil imports year on year. Actually, my prejudice is to believe these are continually growing, but actually they haven't been. They've been declining this year. Is that due to lockdown, or is that another sign of a slowing Chinese economy. And I put this chart in earlier in the week and saying, has energy stocks risen too far too fast? I think we know now the answer is yes.
So it would seem that you should trade against a 4 standard deviation event. That was the problem.
Yeah. And this again is from earlier in the week. And, oil equities, the speed with which they've come off has been really shocking. This is down 22% in 8 sessions. And actually, it's fallen further since then.
Well, Keith, if we want to whistle to keep our spirits up, or at least my spirits, you're out, I'm still in. I noticed that Warren Buffett has still been buying Occidental Petroleum, or one of his lieutenants has been. So he's taking the investment view rather than the short-term view.
Yeah, and a medium term, I think oil prices are in for a structurally strong decade. But one of the reasons I got out is that short-term sentiment trumps everything. And I think there's a fundamental lack of liquidity in all markets, frankly, as we've got rid of market makers and we now rely on algorithms. And algorithms step away when you see strong directional flow. And frankly, that exacerbates the volatility. So when people try and sell, you just see massive downshifts, which is what we've seen over the last couple of weeks.
That is so true. I've been paying a bit of attention to Exxon, and that went from $105 to $85, and it then bounced around. It's incredible. And the idea that markets are efficient is just sort of laughable when you see a massive company like that, its valuation change in such a degree in such a short period of time.
Yeah. No, so I held Exxon. I started selling at 92. I sold the last tranche at 100. And, it kept on going up, got to 105. And I was feeling like slightly foolish that this has been way too early. It's now at 87. So as you say, the volatility is just off chart. And this is one of the reasons that I am so bullish oil medium term. So this is CapEx and the oil price. So the line is the oil price, the bars are CapEx. And normally what you see is as the oil price rises, the market is signaling there is a lack of oil, and the oil industry usually responds by raising CapEx, which in due course brings new supply onto the market and lowers the oil price. This time, there's been no response. So going forward, the oil market is likely to remain tight. So once we get through this recession, I think oil prices rapidly head back up, and I'm expecting volatility. And Sanford Bernstein are saying that the oil price is now at a level where you get demand destruction. Although this chart, again, is before the sell-off of the last few days, which may actually indicate that they were right. The world's swing producer is US shale, which has totally failed to respond to the price signal. And this chart is from shaleprofile.com, which takes a deep dive into the productivity of wells, shale wells in the US. Now, the way to interpret this chart is bottom left, the top of the two subcharts is the length of the average US shale well. And you see that it has continued to grow. So wells are getting longer and they're using more and more proppant as the wells get longer. But productivity per 1,000 feet has stalled, but is actually in decline. So that indicates that the productivity gains that drove the shale oil and gas revolution have now played out. Essentially, we've got very good at doing this, and the only productivity gains in future are from drilling longer wells. They're not from productivity. So if you think about this in sort of solo growth model terms, You have to throw more workers and more capital into it. You're not getting more productivity.
Keith, just before we move on from the US oil situation, I think it's worth pointing out that there's some public to private moves going on here. I think there's an attempt to take a public oil company. Is it Continental? Given the public or the pressure on publicly quoted oil companies not to expand production for environmental reasons, that one response to that is for companies to be taken private, and there's a lot less attention to them if they're privately owned and but still producing the oil. So I think it just highlights the intense difficulty of achieving environmental targets. We need to have a holistic solution to this. You can't just sort of point fingers at large oil producers and blame their supply. You have to be thinking about demand, and you have to think about a holistic transition if you're going to get the ends that you want. There's no point just sort of having a blame game about it.
Yeah, I completely agree, Stuart. We need a plan, but actually the plan is endless virtue signaling and not doing anything. And this is US crude storage in the US, including the SPR. And it is dropping. So current oil consumption in the US is just not sustainable. These are Dutch natural gas futures, and they are rising at the wrong time of the year. We should be mid-season, not burning much gas, rebuilding stocks, but the price has shot up because the Russians have reduced gas flows into Europe. It's best shown on this chart. So, with the explosion in the US LNG plant, the market is worried that Europe will not be able to refill its gas storage in time for winter. And this chart shows gas storage country by country. And you see that we take, for example, CZ, Czechoslovakia, then the maximum storage is the bar, the 80% target is the dot, and current filling is the bar. So you need to get to, there's still a long way to go, essentially. And if Russia has cut off its supplies, then how are you going to fill the storage to the level required to see Europe through winter by the beginning of winter? So this chart shows that in the UK, we have had very strong demand destruction caused by high gas prices. And if you look at the orange bar, industrial and commercial gas use, it has fallen almost 50%. Now that means that manufacturing in the UK has taken a big hit and is very inflationary. That is a lack of supply. We're seeing a supply shock. Okay, so this is US natural gas prices and come off very rapidly. Coal continues strong. Uranium has come off its peak caused by the Sprott Uranium Trust buying. And onto industrial commodities, Stuart.
Right. Well, as Keith highlighted in the charts previously, it's been a tough week in many different markets. Aluminium down 1.9% on the week. No change in cobalt, but I think that's thinly traded. Copper down 8%, known as Dr. Copper for its ability to predict the industrial production cycle. That's not a good sign. Chromium flat on the week. Iron ore off 11%, so it's now flat for the year. Lithium carbonate, again, flat on the week, but up 70% for the year. Neodymium off a touch on the week at minus 0.8%, year to date up 7%. Nickel minus 5% on the week, basically still up 15% for the year. I don't know how much that's distorted by the shenanigans going on at the metal exchange. Tin, after a absolutely tremendous past couple of years, it's off 10% for the week, 25% for the year. Ferrovanadium flat on the week, and zinc off 3.5%. So here's the chart for aluminium. My goodness, I mean, if that isn't a worrying sign for industrial demand, I don't know what is. Falling from $3,500 a ton to now more like 2,500. That's over the past sort of couple of months.
Yeah, and that is despite very high electricity prices.
Yes, yes. Cobalt, pretty flat. Copper, this is the one that interests me. The fall here from $4.4 a pound down to 3.8. And as I've just mentioned, if copper is predictive of the industrial cycle, this is not looking good. Not looking good at all. Talking of copper, it's often talked about as being in short supply due to the energy transition, but that's a strategic long-term observation. If you look shorter term, there are some statistics here suggesting there's actually a bit of a surplus for the next 3 years in terms of visible inventories, but also the supply-demand outlook. I was listening to John Curry from Goldman Sachs a couple of weeks ago, who was making a very similar point to say that actually there were some previous projects coming online in the next couple of years. After that, we're going to get the supply crunch. But actually, in the medium term, there isn't. It's not the same lack of supply picture that we've often talked about in the context of energy transition.
Yes, and I thought this was a really useful and interesting chart. Actually, we go into recession, then you can see the copper price come right back down.
Price of chromium here, not much change. Iron ore, as we've been highlighting in the past few weeklies, has become rather weak, as it were, pretty much after a peak around March. Lithium, very flat. Neodymium, very similar picture as well. Nickel, we can see the big spike to do with the squeeze on the London Metals Exchange, and which I believe is now subject to a couple of legal challenges and investigations. But the picture apart from that is actually one of weakness since around the beginning of May, dribbling off pretty regularly. Tin, my goodness, again, another very sharp change in pattern after having risen very strongly for a couple of years up until March this year. It's come off. I think it must be another of the goose stories from Keith. It's fallen very rapidly.
Well, this is very bad. It shows, well, this says very bad things about demands for electronics, because the tin is mainly used in solder. And it's showing there's a rapid decline in demand for tin for solder.
Ferrovanadium, after a very pronounced spike earlier in the year, seems to be settling down. Zinc, again, similar picture of weakness since, not in this case March, but more like April, May time.
Yep. The generally, all these industrial commodities off a lot from their peaks earlier in the year. And that means that the market is seeing slowdown in demand for industrial commodities. Do you want to keep going?
Sure. Turning now to precious metals. Again, not particularly exciting performance by anything here. Gold off 1.4% in dollar terms, at least over the week, making it just flat for the year. Silver having a bit of a torrid time, off 4% in the week, 10% for the year. Platinum off 3.5% for the week, now down 5% for the year. Rhodium bucking the trend a bit. It's the only one up up about 4% on the week, flat on the year. Palladium off a bit, 1.5% in the week, and meaning basically flat on the year as well. Here's a chart of gold, and the disappointing story basically, given that we were hoping it would act as an inflation hedge. Though I think there are various statistics about statistically whether that is true or not in different regimes, but it's been disappointing, particularly given the amount of QE that there's been. But representing the statistic not in dollars, but in pounds, it's a little bit more encouraging. It has acted as a bit of a hedge against sterling weakness. We can see the chart here over, I think, about the past year. You've actually made money in sterling terms in gold. Silver, very disappointing. I believe there's a bit more industrial use for silver, solar panels, etc. I think you use silver, but a very weak performance after having peaked recently at $28 an ounce, now down to $21 an ounce. Platinum, same story really. Rhodium, again, even more pronounced version of that same story, having fallen from around $18,000, $19,000 an ounce to around $13,500 now. Palladium, same story.
Okay, thank you, Stuart. Okay, so yields actually fell this week as the Fed talked about the possibility of recession, and having sold off hard following the bad CPI print 2 weeks ago, rates fell slightly, particularly at the short end. Now, currently, the ECB is managing to talk the market down. So we had falls in periphery bond yields. But frankly, I think that is temporary, and confidence in the Eurozone is fragile. And unless the ECB comes through with a convincing plan to support the Italian and Greek bond markets, you will see a renewed sell-off in due course. An overview, this is the returns of global bonds, the Bloomberg Global Aggregate Bond Index over this year, and it is the worst ever since they've started doing this. If we look at the US, the same. So bond yields rising from historically low levels have been very bad for bond investors. And so far, the bond market has not responded to recession fears. So generally, when you get negative economic surprises, bond yields tend to fall because the bond market starts to discount a recession. But these are not normal times, and the market is worried about elevated inflation and, frankly, the possibility of stagflation. So this goes to show how relying on historic correlations can get you in trouble. This is the Italian 10-year bond yield. It is down from recent peaks, but is still elevated. And if bond yields to stay at this level, then Italy remains in trouble. This is Greece. Reminder, most Greek bonds are held with institutions. Italy is the problem, not Greece. UK 10-year, it has ticked back down, but, early days. This is not by any means evidence that the market has turned and we've seen a peak. We have seen other drawbacks, pullbacks previously, only for a bad inflation print to see yields continue to rise. And reminder, the Bank of England thinks that inflation in the UK won't peak until October. So it is too early to think about buying bonds. And on that note, my small position in the 2071 gilt actually bounced quite hard this week, but I'm not adding to it. So I think actually in order to see the bottom of any downtrend, you need to see convincing evidence that what has worried the market has changed. There's been a bottom. So what I think is worrying the market in bonds is inflation and interest rates. And I don't think either inflation has peaked yet or the interest rate cycle has peaked yet. And so until they do, I'm not adding to my tiny position in gilts. US 10-year, and we are entering a phase of directionless volatility before things get really bad. So concluding comments. Well, bad week for commodities as the market begins to price in the possibility of a recession. Leading indicators in Europe and the US signal that the economies continue to grow, but growth is slowing. And investors are pessimistic about both the economy and the outlook for equity markets, but they continue to buy equities and they remain very overweight equities. And if they were to suddenly start moving their positions to be more in line with what they think are the prospects, then that means they'll be selling down very bad. Okay, and on that cheery note, Stuart, what have you been up to this week?
Very little, very little. When I was on a couple of weeks ago, my portfolio was down, I think, a couple of percent for the year. It's not bounced, of course, in the performance, given the performance of markets over the past couple of weeks. So I'm down, I think, about 4% year to date now. I just don't have your conviction about the macro call. I'm rather more sort of traditional and think that timing the market is very difficult. You've been absolutely spot on. I mean, almost to the week. It's been a great performance by you, Keith. The only thing I would say is that there's two decisions that you need to make if you are going to be a cyclical top-down investor, and that is you need to sell, which you've done, but at some point you need to buy back as well, and that's what I think can make a problem for top-down cyclical investing is getting back in. I don't have enough courage in my own ability to do that, so I tend to sort of sit with things and harvest my yields and gradually compound up, or in this case, compound down.
Yes, I think what you're doing, just looking for investments with good real returns and ignoring the cycle is, a perfectly good strategy. My own strategy, I take a lot more risk and I try and time the market. Okay, thank you, Stuart. So I had a pretty indifferent week, down 0.5% on the week, as my remaining rump position in Shell had a bad week, and I'm very glad I sold the vast majority of my positions. So I underperformed the all share despite being almost 90% in cash. But it's been a good year, and the whole reason I cut risk position was in order to preserve that outperformance. During the week, I added a position in big size. And can I thank the Discord member, Russell Yu, who during the week got in touch and asked me what I was doing with the cash. And I thought, well, it's all just sitting in sterling, earning 0.1%. And previously, when I was 90% in oil stocks, I was, of course, hedged against the fall in sterling. And so I can't hold currency on my brokerage account. So I thought, what can I do to move it into US dollars? And there is an iShares ETF 0 to 1 year, but for whatever reason, I couldn't buy it. It is not available to me on my brokerage system. So instead, I bought the 1 to 3 year, which is currently yielding about 2.5%, and essentially is about as cash-like as I can buy. So I have moved about half my cash into US dollars into this ETF, which is incredibly liquid. If you look at the amount of shares on the bid and ask, they're about 1 million. So huge volume. So it's very liquid and the spread is very small. And the annual charge is 7 basis points. So this is my asset allocation at the start of the week. Equities, 8.6%. So I am 90% in cash, have a little bit of bonds, which frankly have been rubbish. But despite being 90% in cash, I still lost 0.5% on the week. So oil down 7.2%. Even my safe haven positions, such as in diversified energy, had a bad week. So this is the price of the IBTS, iShares US Treasury 1 to 3 year ETF. And essentially it's been rising recently because sterling is selling off. This is all in US dollars, not priced in sterling. Well, it's priced in sterling, but all the assets are in US dollars. And that is what I'm doing. I'm essentially hedging my sterling into a strong currency. If Boris Johnson decides to revoke the Northern Ireland Protocol, the EU will be able to put tariffs on UK goods, and that would be absolutely catastrophic for sterling and is something I really want to hedge myself against. Other companies that we've discussed previously on the podcast, well, this is Southern Energy Corp, and I bought it down here, and thank you to Luke Oldfield for putting me onto this company. And I sold it along with all my oil companies earlier in the month, getting an average of 67. And today it is announced a share placing at 55p, and the shares have dived. Now that is always a danger for these small oil companies. They need capital. They tend to do placings at a discount to the share price. And talking of which, this is an oil service company, Lamprell, which I bought in 2020 as it rose sharply, and there's a lot of optimism in the market about the future for oil and gas capex. And then essentially it didn't do very well. It became clear that it needed funding. I sold at a decent loss, but thank God I did, because the results today were frankly absolutely catastrophic, and the company needs money. And if you try and raise money in this market, well, it's going to be difficult. We saw that with Tecmar, which again put itself up for sale because it needed cash. Share prices absolute collapse. The same has happened to Lamprell, down 70% today. So if you have any shares in your portfolio which may need funding, be wary. It might be best to sell them before they announce that fact. And that's it for the week. So thank you very much for watching. Please can you press like and subscribe to the channel. Thank you very much to Stuart Owen for filling in from Tokyo in the absence of Richard. Now, I should warn you that next week, none of us are available. I will be hiking in Corsica, and I will do a weekly when I fly back in on Saturday, but it will be very short. It will just be the checklists. So be aware. In the meantime, thank you to Stuart Owen, and goodbye from Stuart Owen.
And goodbye from Keith Jordan.
Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.